Hey guys, today we want to talk about a simple student loan hack for you guys that are going through transitions from residency into practice as a physician. So really excited to break it down for you today. But if this is your first time joining us, welcome. My name is Michael Foley. I'm a certified financial planner and certified student loan professional, and I'm also the son of two doctors. And really developed lifestyle creep for healthcare workers and their families to really help them to be more intentional in their finances and really have some more actionable and simple financial steps to help them get more educated in their own finances and hopefully live more humble and quiet lives through the process. But let's dive in today. So the big thing that we want to be talking about is how do we report our income for our student loan purposes, right? So if you guys aren't familiar, we'll probably be doing another video here on the different ways that we can report our income. But essentially, typically there's three different ways, right? So you can typically report based off your employment contract. So if you have that signed contract of what your new job is post-training is going to be, you can use that to justify your income. Usually not most advantageous, but that's one way. The other one is we can use a pay stub. So we can show them, hey, this is our pay stub, this is my pay stub, this is how much I'm getting paid throughout the year, and that can justify that. Or you can use your most recently completed tax return as long as it's been within the last 2 calendar years, right? So oftentimes that's what we're using, but a lot of people forget that there's also a fourth option that you can use that is really a great opportunity during this transition time is anytime you are unemployed, you can recertify your income. Right? So what that means is that if you go and you say that, hey, currently, if you don't have a job at any certain point, you can say, hey, I don't have a job, I'm currently unemployed, and they will drop your payment to zero, and then you'll have that payment for the next 12 months, because typically you have to report your income every 12 months. It's got a little wonky through COVID, but normal rules, 12 months is how long you have. So when you go and report your income as unemployed, we have a 12-month period of time that we can use that, okay? So anytime, if there's a gap going from residency or fellowship into practice, oftentimes the clients take a month or two before they actually go in, and there's a month or two gap where they are genuinely not employed, right? So don't get me wrong, this is not something that you can do if you are getting paid through some other source. You have a side gig, you're doing locums work, you're doing something else. That's not, you can't just say you're unemployed for that, right? But if you generally are not under a contract for any institution, there's no reason that we need to interpret this rule in the least favorable way possible for you, right? So if we're looking at that's a big difference, in that, and that could be a great jump start for a lot of our clients, whether that be paying off their loans or going for loan service, public service loan forgiveness program. A lot of things that we can do with that captive 12 months right out of training, maybe building up emergency reserves, doing a lot of different things, right? But let's break down the math on how impactful just that 12-month period of time is, right? And what we can be using that for. So thanks to this new plan that just came out called the SAVE plan, and I have another video on the SAVE plan as well if you're not familiar with how that works. But essentially, the SAVE plan doesn't you have to report based off of your income and your household size, but then any unpaid interest on a monthly basis gets completely subsidized for you. So if we're reporting your income as unemployed, that means you have a $0 income. Therefore, you're going to get a $0 payment. Therefore, you have zero interest accruing on your loan if you're on the SAVE plan for that whole 12-month period. So that's super helpful for whether you're going to pay off just pay off the loans genuinely. That's huge interest savings, or if you're going for PSLF, that's huge payment savings, right? So let's actually break down the math here and run a scenario. So let's say you have $250,000 of loans outstanding, right? And we're going to assume a 6.8% interest rate on that, where most of the federal loans are these days. And then let's say your new job that you're starting at is going to be at $300,000 of income, okay? So let's run that as a baseline. So if you were to interpret the rules in the least favorable way possible for you, what you would do through that transition is you would show them your contract and say, hey, I'm making 300 grand starting in September, right? And then they would justify a payment on the save plan for you. That would be about $2,226 per month. So that would be how much you'd be paying per month. So over the span of the first year, that's over $26,000 of actual payments that you're making on your loans for that 12. So if you're going for the public service loan forgiveness track, that's real savings, because that's actual dollars that you're never going to have to pay towards those loans, because guess what? That whole time frame that you reported as unemployed, you're still enrolled in the save plan because you reported your income, right? And your income was just so happened to be zero at that time. So that whole year counts as a qualified year towards the PSLF for you, but we didn't have to make any payments for that. And so that just saved you $26,712, right? That's insane, right? That's just from that one switch, that 1 year. For that little time frame that you're unemployed, we can report that. That's saving over $26,000, okay? Crazy. Now, let's say you're not going for the public service loan forgiveness. Let's just say you're going to be paying off those loans, okay? Well, this new save plan is almost incentivizing people not to pay their loans off quicker at a certain extent, because even if you reported a $0 payment, if you made an extra $1,000 payment, all of that's going towards interest, right? Because you got to pay that interest that gets accrued on the loans first before it ever starts going towards principal on the debt, right? So it really doesn't make any sense on that. And so if you look at it, if on a $250,000 loan at 6.8% interest, so bear with me if this is kind of your situation, but you're accruing about $1,400 per month on your loans, right? So that's a total of $17,000 over the year that you're accruing on those loans. So, but remember, on the save plan, they subsidize any unpaid interest. So if we're accruing $14,000 in interest on the loans, but our payment based off our income, which is unemployed, right, is zero, that means you're saving $1,400 a month on interest that you never have to pay on that loan. So if we do the strategy, we report you as unemployed during that time, then that is genuinely saving you $17,000 in interest that you will never have to pay on that loan. So what we typically do in that scenario is, if we can actually get you enrolled and use a $0 payment for that time for that first 12 months, well, then what we can do is say, all right, well, however fast you wanted to pay off those loans, we put that amount, instead of putting it towards the loans, what we can do is put that towards like a high yield savings account, right? And we're earning like 4% or more right now on, in 2024, what we're looking at from some of these interest bearing accounts. So now we're growing our savings at 4%, and that debt is not costing us any money. And then once we get to a point where we have to report our higher income and we're not getting any interest subsidies on the save plan, then we can just chunk that amount that we have in the savings account. We can chunk that down towards the loans at that point, and that can really turn maybe a 10-year payment plan maybe into like 8 or 7 years, right, depending on how long we can have that $0 payment or an artificially low payment based off your income, right? So that's just tangible savings. So I love the spirit. If we want to be looking at paying off these loans ASAP, trust me, I am a big proponent of just getting these loans behind you. However, if we can get there faster by being patient and playing the game on the federal loan space, that's gonna be better long term for you, and that's just less money in the Department of Ed's pocketbook here, right? We want to get you to the point where you're the bank, right? We're not just keeping all these other banks in business, right? So that's a huge savings. So what are some things we got to look out for on this, though? There's really a couple things that I want to be thinking of. Is the first one is spouses, right? So if you're married, that could kind of throw a wrench in this, right? Because if you're married and you file your taxes jointly, then you have to declare any of your spouse's income. So if you're unemployed, it will show as if you're making zero, but your payment is actually going to be just derived based off of your spouse's income. So you're not going to have a $0 payment unless your spouse does not work, right? Then you could still have a $0 payment. Now, if you filed your most recently completed tax return separate, then you're clear, right? Because if you're filing your taxes separately, they still will not look at your spouse's income even when you report as unemployed. So that's another great opportunity for us to take advantage of that. If you did file separately, zero, and you can report as zero income or unemployed. That's a big thing. But one of the other things that we see is sometimes, a lot of our clients have a very tight window of when they're unemployed, right? So we like to try to play this game if we can, but oftentimes the loan servicers don't work with us all the time. And so sometimes they have delays in the processing, and sometimes we have to redo applications, right? Even if everything's done completely perfectly the first time, there may be a glitch in their system, or they didn't process it and they're like, oh, hey, can you just report your income again? So we got to be careful, because sometimes if we report during that, we sign the application while you're unemployed, but then they don't they process it, and then they're like, oh, well, actually we have to have you redo it. Sometimes when you have to redo it, technically you're employed at that point, and so that could really throw a wrench in that situation. So we got to be cautious. So it's worth pursuing, but oftentimes, as we'll talk about in another video too, is even just using our most recently completed tax return is still way more favorable than reporting your $300,000 contract, right? So if we can use our resident or fellow income and extend that, you're still getting a lot of interest subsidies, even if you don't play the unemployment game during that process. But so just something to be thinking about. So again, I'd like to have some of these kind of simple tidbits of just actionable information. And if you're going for PSLF, this is a great way to save almost like well over $25,000. If you're just looking to pay these off, you're saving $17,000 in interest in those situations that we gave. That is real tangible money that we can repurpose for other areas to extract more life out of the money that you do have. So hopefully this has been helpful for you, and we look forward to chatting in another episode.